We got a great presentation today for everyone out there. We are going to be talking about planning opportunities with qualified small business stock with Stephen Ching and Heather Boda. Great topic. Please pay attention because there could be savings of millions and millions of dollars if your investment qualifies for this, what's called 1202 stock. And then secondly, we're going to talk about some other creative tax planning strategies with myself and Nick Omenia. So without further ado, I'm going to hand it over to Steve to start the presentation on 1202. Steve?
Okay. Thanks, Pat. So in this presentation, what we'll first do is we'll give a general overview of the QSBS benefits as well as the requirements. We'll look at common QSBS planning items and pitfalls that we commonly see with our clients. And then finally, Heather will conclude with estate and gift planning considerations and other considerations with respect to QSBS. So what are the benefits of QSBS? So generally, a seller can exclude between 50% and 100% of gain on the sale of QSBS, and that's the greater of 10 million or 10 times basis. And I guess the percentage exclusion depends on when the stock was issued. So any QSBS issued after September 27th, 2010, that qualifies for 100% gain exclusion. Any stock that's issued between February 17th, 2009 and September 27th, 2010 qualifies for 75% gain exclusion. And then anything between August 10th, but before February 8th, 2009 qualifies for the 50% exclusion. So you'll see that kind of as the years, in kind of the later years, you qualify for the 100% gain exclusion. But then if it's the earlier years, then kind of that exclusion percentage goes down. So who can benefit from QSBS? Individuals, trust partnerships, and S corporations. C corporations are kind of excluded from this Section 1202 benefit. So here's an example of calculating the maximum gain exclusion. So in this example, shareholder A, they sell QSBS that they received on September 15th, 2010. There's a basis of 0 and they sell it for 10 million. So the first step is to determine A's total gain. So in this case, since they have a basis of 0 and they're selling it for 10 million, their gain is 10 million. And then you look to see whether it's greater than 10 million or 10 times the basis. So in this case, since the basis is 0, $10 million is the total eligible gain. And then since the QSBS was acquired or was issued in September 15, 2010, it qualifies for the 75% exclusion. So at the end of the day, the maximum excludable gain is 7.5 million. So A would be able to exclude 7.5 million under Section 1202, and then his 2.5 million would be taxable. So one of the first requirements is the issuing corporation must be a C corporation in order to qualify for QSBS. So it must be a C corporation at the time of sale, and then it must have been a C corporation for substantially all of the shareholders' holding period. And Section 1202 doesn't define what substantially all is, but some tax practitioners have said over 90% of the holding period. And then the second requirement is the QSB requirement. So the corporation must not have more than 50 million in aggregate gross assets immediately before or after issuance. So at the time you receive the stock, it has to be less than 50 million. But that doesn't mean that after the issuance, it can't exceed that 50 million. So let's say that you got issued your stock today and the issuing corporation had less than 50 million in assets. And then 10 years later, it was $20 million, 200 million in assets, you would still qualify for QSBS under that circumstance. The other requirement is the original issuance requirement. So the shares have to be issued directly from the C corporation. So if you acquire stock from another shareholder in the C corporation, that doesn't meet the original issuance requirement. and kind of in this vein, any restricted stocks or stock grants that you receive from your employer or the C corporation can qualify for this original issuance requirement. And then similarly, if the stock was originally acquired and then, the shares were later gifted or transferred upon death, essentially what happens is the donee steps in the shoes of the donor, and they can kind of qualify for this original issuance requirement despite being transferred the shares. And then there's certain tax-free reorgs and kind of contributions that allow you to retain those QSBS characteristics, and any distributions from a partnership, the partner, of course, subject to limitations. Another kind of pitfall that we try to avoid is, if there's certain redemptions of C corporation stock before or after issuance, it can result in a disqualification of QSBS status. So there's two types of redemptions that can be disqualifying. So the first one is if there's a redemption that's exceeding 10,000 and more than 2% of all outstanding stock, that can disqualify a seller from QSBS status. And this period, when they're kind of looking at this redemption, they'll look at 2 years prior to issuance and then 2 years after issuance. And then it also applies to related parties of shareholders as well. And for this redemption, it's only applicable to the shareholder involved in the redemption. So all other shareholders that kind of received, that were issued C corporation stock over this 4-year period can still qualify for QSBS. It's just applicable to the shareholder involved in the redemption. And then the second type of redemption is a substantial redemption, which is any redemptions exceeding 5% of all value of outstanding stock. And then this kind of time period is 1 year before and 1 year after issuance. And unlike the first redemption, all shares issued during this 2-year period can be disqualified as QSBS. So here's a real life client example that we recently went through, where a significant redemption essentially disqualified a seller of QSBS from qualifying for Section 1202. So this private equity firm was looking to sell one of their investments. So we started poking around kind of how they originally acquired the stock. And what they did was essentially they contributed cash for 51% of the C Corp. And then that cash was used to redeem the founders. And since basically the redemption exceeded 5% of the total value of all outstanding stock, that essentially disqualified the private equity firm from qualifying for QSBS. And in this case, they kind of met all the other requirements except for the significant redemption requirement. So the takeaway for this is, every time there's, a C Corp is looking to redeem a shareholder, you'll just have to be careful that it doesn't trip any QSBS requirements. And then finally, the last requirement is the 5-year holding period. So essentially the shares must be held for 5 years. And then for employees receiving any stock grants, the 5-year clock starts from the time of vesting or the time they make the Section 83B election. And then for any taxpayers that receive the QSBS as gifts or from estates, that the holding period of the transferor basically tacks on to the taxpayers, to the taxpayer receiving the QSBS. And then I guess before we move to the next section, there was another requirement that I forgot to mention. It's the issuing corporation also has to be engaged in a qualified trade or business. So essentially, Section 1202, it doesn't kind of define what that term means, but it provides a laundry list of excluded professions, from law firms to accounting firms to architecture firms. So basically anything where kind of the main part of that profession is providing services, or it depends on the skill of the employees. And that's the requirement that we kind of poke around at most, because it's the most nuanced. There's not a lot of guidance on it. Whereas the other requirements, you can kind of structure around it. So one common item that we counsel clients on is, there's a client, they're an S corporation, and they're looking to qualify for QSBS. Revoking an S election won't generally allow the shares to qualify for QSBS. So if an owner owns 100% of S Corp stock and then they revoke their S election and then revert back to a C corporation, that won't allow them to qualify for Section 1202 because they received the stock while the issuing corporation was not a C corporation, so they would fail that C corporation requirement. And similarly, if you convert to an S corporation before the sale, it'll generally disqualify you from qualifying for Section 1202. Here's a structuring example that we commonly advise clients on. If they're an S corporation and they're looking to qualify for a QSBS. So essentially in this structuring option, the S Corp, they'll form a new C corporation, drop their assets in the new C corporation, and that allows, essentially that contribution allows the S Corp to qualify for the original issuance as well as the C corporation requirement, where their shares were issued by a C corporation. And kind of two items I want to point out is, when owners do the structuring option, the common question that we received is, can they just liquidate the S Corp or does it have to stick around? We generally advise the shareholders kind of keep the S corporation around, because if they liquidate, then basically that liquidation is treated as a sale of all the assets from the S corporation to the individual shareholders. So in this case, the individual shareholders, they'll be taxed on any gain on the liquidation.
Hey, Steve, based on the structure, do I still, if I contribute everything into that C corporation, do I still have to wait another 5 years?
Yeah, essentially, when you drop the assets into the C corporation, that's when the 5-year clock starts. Another common issue that we advise clients on is in a lot of our deals, there's always a rollover component. So management, they'll usually continue with the business post close. So there's kind of rules under Section 1202 that allow sellers to qualify for QSBS on the rollover equity. So if the rollover stock they received is not QSBS, basically the Section 1202, it'll only exclude gain on the appreciation of the QSBS exchange at the time of original issuance. But then if you exchange QSBS stock for QSBS stock, the Section 1202 can exclude appreciated gain at the time of the exchange, as well as any subsequent appreciation after the exchange. And then for both circumstances, the holding period kind of tacks on. So if you exchange your stock in 2018 and then you had already held your stock for 2 years, that 2 years kind of tacks on to the stock that's exchanged. And then here's just an example of a seller rollover. So in this case, Allison, she sells 80% of her shares in Acme Corp to X Corp, to X Corp, and then rolls over 20% of her shares. So if she contributes her Acme shares into X Corp in a 351 transaction, which is basically a tax-free contribution, she could potentially qualify for Section 1202 once she sells her shares of X Corp. And I guess the last item I want to point out is there's kind of a analysis of whether you want to do a tax-free or taxable rollover. So if your maximum exclusion is way below like 10 million, then you'll want to potentially explore doing a taxable rollover because you can trigger that gain and then have a higher tax basis on your rollover equity. Whereas if your potential gain is going to exceed that 10 million, then you'll potentially want to basically defer some of that tax, defer some of that rollover equity. And then I'll pass it to Heather for the other considerations in the estate planning piece.
Thank you, Stephen. So what if I don't own the stock for 5 years? Can I still get the benefit? Yes. Stephen had mentioned before in the rollover example that you could, there's opportunities. So QSBS rollover can be done under Section 1045 when you're actually selling the QSBS stock that was held for more than 6 months, but not more than 5 years. The shareholder has 60 days to reinvest the proceeds into replacement QSBS. So this is alternative to the seller rollover that Stephen mentioned. The gain on the sale of the original QSBS will be deferred to the extent the proceeds are reinvested. The new corporation must meet the 80% active business test for at least the first 6 months to ensure deferral. And the new QSBS is treated as if having the same holding period as the original QSBS. So if you held it for 4 years, the QSBS, and then sold it, and it didn't qualify for the 1202 exclusion, when you invest within 60 days, you would then have already 4 years of holding period on that new stock that you reinvested. The 1045 QSBS rollover could be an existing qualified trade or business or a brand new one. So in some cases, clients come to us and ask if they need to actually start a new business, or if there could be an existing, as long as the existing qualified trade or business isn't over the $50 million and is still in the QSBS stages, you can make that investment. Another issue that comes up while we're doing 1202 planning is the considering states, because not all states follow the federal $10 million exclusion. So the following states do not conform, and the gain would be taxable: Alabama, California, Mississippi, New Jersey, Pennsylvania, and Puerto Rico. I personally have experienced it in California and New Jersey, and it has shocked our clients. So therefore, I want to make sure that people are aware of it. Other states that they partially conform is Hawaii and Massachusetts. Obviously, always speak to your Citrin Cooperman tax advisor when going into these transactions to understand the full tax exposure. So estate and gift planning considerations. Shareholders can gift QSBS stock to non-grantor trust or directly to loved ones. And the transferee steps into the shoes of the transferor. They have the same original issuance, the same holding period, and the same basis. You want to be careful to make sure that you've created and watch out for unintentionally defective grantor trusts. Be careful with the language in your trust document to make sure that there are no triggers, such as the spouse being granted the power to invest. Don't give the grantor or a non-adverse party power to borrow principal or income without adequate security or interest. No substitution or power to swap. No restriction of power of disposition over beneficial enjoyment. No income for benefit of the grantor or the grantor spouse. Also consider savings clauses in your documents. That's not to say that you can't originally make the gift to a grantor trust. However, if the gift is to a grantor trust at the time of a sale, and the grantor would then pick up the gain, and therefore it would defeat the purpose of the gifting to the trust to get multiple bites at the QSBS apple. And so you would want to consider turning off grantor provisions prior to the sale of QSBS stock. The best time to make the gifts of the stock is when it has a lower valuation, using less of your lifetime exclusion. Right now, the lifetime exclusion is $13.6 million per person, and the annual exclusion is $18,000. You want to do these gifts when the value is lower. It's usually closer to when the stock is purchased. Therefore, you are using less of the exemption. Be careful to, if you're going to do stacking, which is making gifts to multiple trusts, you have to make, so again, getting multiple bites at the $10 million exclusion. You want to be careful that the grantor and the beneficiary are not treated as the same. So therefore, if the grantor has 5 children, set up 5 separate trusts for their children, so that there's no confusion as to if these are all the same trust, and therefore excluded for the $10 million, only get one exclusion. Another area where you can do planning is to gift the shares into a GRAT, which is a grantor retained annuity trust. The GRAT is usually set up where a distribution is an annual distribution is made to the owner over a period of time. Once the period of time is over, the stock that still is in the trust will go either outright or in trust to beneficiaries. At that point, it would no longer be a grantor trust and therefore allowed its own $10 million exclusion. And lastly, you would consider when someone passes away, because again, the beneficiary would step into the original owner's shoes for the original issuance and qualification for QSBS and holding period, that the owner should consider having multiple beneficiaries of the QSBS stock, therefore getting more $10 million bites at the apple.
And then Heather, before we kind of go to the next slide, we had a question on what type of businesses qualify for Section 1202. So it's a really nuanced answer, and that's usually one of the first questions I ask when there's a client looking to qualify for QSBS. So Section 1202, they provide a laundry list of businesses that don't qualify. So that includes accounting firms, architecture firms, law firms, healthcare firms, consulting, or basically anything where kind of the principal asset of that profession is the skill of the employee. So essentially Section 1202, they just want to exclude anything where the primary kind of service is like services. So if you're looking for QSBS, like anything from like manufacturers, any kind of non-service businesses would qualify. But it's definitely something that's facts and circumstances specific, because there's not a lot of guidance available, either in like the rules or the IRS. So that's something that we kind of poke around at and kind of just ask very pointed questions, because it's a very facts and circumstances determination.
Stephen, as you've done some planning, what are some of the more prevalent industries that you've done this planning for?
Yeah, so we do a lot of manufacturers. So for instance, we had a manufacturer, they manufactured like filters to kind of filter out carbon dioxide. So a lot of our clients are kind of just like the old school manufacturers. The one kind of business that's a little bit squishy is like SaaS businesses, because we'll have to kind of determine whether it's like the software that's kind of the value, or are they kind of doing IT consulting or kind of some brokering, some brokering activity. So for instance, we had a client that was kind of like an Airbnb type of business where they, people would kind of book places online, and we weren't comfortable with them being a QSBS business because it kind of fell under that brokering activity. So for those kind of SaaS and software related businesses, it's something that we'll kind of have to ask like pointed questions about.
Well, Heather, could you just talk about that other concept of stacking, how we can also, allow an individual to basically exclude more than that $10 million with a little additional planning?
Yes, it would, especially now. Now is the best time to be doing that planning as we're looking to the sunset in 2025. December 31st, 2025, where the exclusion is going to go down or is scheduled to go down to probably something indexed close to $7 million. Now is the time to start doing your gift planning and speaking to your attorney to get these trusts drafted. You don't need to get them funded or the valuations done at this moment. But again, the sooner you do the gifting and the value and get the lower valuations, the better it is, because you'll be using less of your lifetime exclusion. But if you, again, planning on multiple beneficiaries, assuming that you have enough beneficiaries to make the gifts to, there you can make them for your extended family, just making trusts for different people. There are certain states where you can make gifts to INGs, which are a little bit more complex. And for those who are in New York, New York doesn't acknowledge INGs, so that sort of planning is not available. But for, you can do multiple trusts or outright to multiple people, and that will get each trust or individual a $10 million exclusion, assuming that the income isn't picked up on the grantor's return. So you just have to make sure that the substantially the same grantor and beneficiaries are not the same, and the provisions are not always the same. So you could have possibly even where a husband and wife set up two different trusts for their children separately, but you have different provisions, and take that into consideration, where you might be able to get two bites of the apple for two different trusts. And going back to the INGs, those are incomplete non-grantor trusts, but they did, again, New York has issues with that, so they will be brought back into the grantor's return for state purposes. California also does not allow these INGs anymore, so therefore it would be income to the grantor. However, for New York, for California purposes, it wouldn't be too much of an issue, because it would be taxable to California anyway, because they don't acknowledge the QSBS. So those are various different things. And of course, these are the rules based on current laws, and whatever happens in the ongoing administrations, these 1202 rules and exclusion amounts could change. So just remember that for either federal or state.
Thank you. Thank you, Heather and Steve. As you see, 1202 is a great code section that, if it applies to you, that you can exclude 10 million plus. As Heather alluded to, there was an article I read probably about a year ago in the Wall Street Journal that this individual implemented this stacking concept. So instead of eliminating $10 million a gain, he eliminated $100 million a gain on a sale of stock. So it's a very powerful code section if it applies to you. So that's why we want you to reach out to your Citrin Cooperman tax advisor if you're making those investments. Let's see if 1202 applies. We're going to go into another direction now and talk about some creative tax planning strategies. When I go to a lot of webinars, I'm always looking to what else is out there. What's happening in the marketplace? What else can we bring back to our client base and help them achieve some tax savings? After the 2017 tax law, the government pretty much eliminated most of our tax deductions. There's basically three primary tax deductions on your Schedule A that people utilize in today's world. It's interest expense, it's taxes, and it's charitable planning. We're going to talk about two of those three with some creative strategies that we have implemented for some clients. So the first one deals with interest expense. Most people buy a house to get the interest expense deduction. When you're buying a house and you get a mortgage on that house, that's considered what's considered acquisition debt. And acquisition debt is generally limited to $750,000 of mortgage debt. So if I go out and I buy a house for $750,000, I'll be able to deduct all the interest on that mortgage. However, if I now go out and buy a much greater house and I put a mortgage on my house of let's say $1.5 million, I effectively can only deduct 50% of the interest that I'm paying. Not a good answer. Not a good answer. So, we have a lot of clients that are going out and buying, $1 million, $15 million, $20 million houses. And if they put a mortgage on that property, they're basically getting no benefit of all the interest expense that they paid. So I had a client a few years ago, had a $15 million mortgage on a second house in Miami, paying $400,000 of interest. So getting no tax benefit for paying $400,000 of interest. So at a 50% tax bracket, he was losing out of $200,000 of tax savings in a given year. So he came to me and said, Pat, what can we do? Well, I went to him and I said, I have a strategy. And that's what we're talking about, creative tax planning strategies that I can help you save that $200,000 of tax. So this is what we did. As I said before, when people take out a traditional mortgage, that's called acquisition debt. This was a extremely wealthy individual that had a lot of investment income. Investment income, I mean, he's generating a lot of interest, dividends, and pretty much interest and dividend income. So we need to have that acquisition debt converted to investment interest expense. And this is what we did. I had the client pay off his mortgage. He took $15 million out of his bank account, paid off his mortgage. We waited 90 days. Why 90 days? When you look at the regulations that deal with interest expense, 90 days is not a defined term, but it is a safe period that I believe the IRS would allow. So we waited 90 days. I had him take out another mortgage on the property, but what we did was he took that $15 million of proceeds and we set up a new investment account and we transferred that $15 million into this new investment account. And by doing that, we converted that acquisition debt, which I alluded to before, to an investment interest debt. And investment interest expense on that debt is deductible to the extent of his investment income. This individual was generating a tremendous amount of interest, dividends, and capital gains. And by putting that $15 million into a new brokerage account, all that $400,000 of interest is now deductible against his investment income. We just saved that taxpayer $200,000 on a go-forward basis. Now, there are a few nuances. If you set up that new brokerage account, you can't buy tax-exempt securities. You need to buy taxable securities because the government doesn't want you paying no tax on the investment income that's being generated and getting a big tax deduction. And that's one of the primary motives. I always advise clients to set up a separate investment account because if you then took that money out after you put it in there and went out and bought 10 personal cars, the government could construe part of that interest income as personal interest as non-deductible. So we set up that separate investment account. You're leaving the money in there. It's generating all that interest and dividends, and you're getting now a tax deduction. So we just saved that client $200,000, and we've been doing this for 5 years. So over the 5 years, he's saved himself over $1 million of taxes. Creative strategy. It doesn't work for everyone, but it's something that if you have the right facts, you should be looking, your advisor and you should be looking to see if the facts will work in your given situation. Because interest expense is all about tracing. where did the funds go to? When people buy a house, generally, they're using it to purchase their house. Here, what did we do? We paid off that debt. We took the new mortgage out and we put it into an investment account. And that gives me the ability to treat that as investment interest expense as I pay off the debt. Great creative strategy that we've implemented for a number of clients. And our clients have saved, millions of dollars by implementing this strategy. Any questions on that strategy? So you really got to sit down with your advisor, see if the math works, see if the numbers work, and effectively we want to just convert away from acquisition debt, because that's capped at $750,000, and implement a different strategy to maximize your interest expense deduction.
There is a question that came in. Didn't he realize capital gains in liquidating the $15 million?
No, in this example, the individual, that's a great question. We don't want to do something that's gonna generate a tax liability. In this example, this individual had tremendous amount of cash just sitting in his bank accounts and his other brokerage accounts. So we just took that cash to pay off that debt. And remember, one of the things this taxpayer said to me, Pat, I want to be in the same economic position that I was in by paying off that debt. And he was after 90 days. He was out of that market for that $15 million for that 3-month period. But after that 3-month period, he was saving himself, big dollars. So we were in the same economic position, 90 days after this strategy was implemented. But whoever asked that question, you don't want to generate selling capital assets to generate the cash to pay off those funds, but you got to look through the whole process to determine, if it's a viable alternative. As I said, this individual had plenty amount of cash that was sitting on the sidelines, not being invested. So it was a perfect strategy to make this happen. And like I said, that was one example. We've implemented this other example on numerous other clients. So that's, as I started off the conversation, there are 3 basically main deductions: interest expense, taxes, and charity. The other one here is a position to take. And this really deals with co-op taxes. And it's primarily for individuals that are co-ops are primarily in the New York City marketplace. When the IRS changed the tax law back in 2017, they limited your state and local taxes and your income taxes to $10,000. However, co-op taxes are under a different section than state and local taxes and real estate taxes. There is a position to take, and we've implemented this position, to allow the co-op taxes to be fully deductible in addition to the $10,000 that the government's giving you. Now, the government has issued notices stating that they intended for co-op taxes to be part of the $10,000 limit. But here's the catch. They never changed the tax law. They never changed the law to put Section 216 in that $10,000 limit. They have issued notices stating, hey, we intended for co-op taxes to be part of that $10,000, but they never changed the law. We believe that gives us the ability to take a position to allow those co-op taxes to be deductible in addition to that $10,000. Now, I've done it for a lot of clients. And I did get a notice from the IRS probably about 4 months ago. We responded to the IRS, quoted all these tax provisions. The IRS was not budging because they were banking on the notice that they issued saying we intended. This taxpayer did not want to fight it further and basically paid the assessment. He did get some benefit for 2 years before the IRS caught on in year 3. But he did not want to continue to fight with the service. So we conceded in example. But we believe we can take that position. And I said, we've done it for a lot of clients, take that position and deduct that co-op taxes in addition to that $10,000 limit. What we're trying to come up with is creative strategies. The IRS, as I said, it's not part of the tax law. So that gives us the ability to take a position. We disclose that position on the return, so the taxpayer is not subject to any penalties. Government would always knock out the deduction and impose the tax and interest on that deduction that they're knocking out. But if you disclose it, you're not going to be subject to any penalties. You always want to talk to your tax advisor. If you're an individual that's always concerned, you might get a notice from the IRS. I would shy away from taking that position. But there is a position out there to take for co-op taxes. So, dovetailing back, we talked about a creative interest expense strategy. We talked about a real estate tax strategy. We're not going to have enough time to get into charitable planning. That's the only other deduction. We can do that at a future date. But I'm going to bring in Nick Ominio, who's one of our T&E directors at Citrin Cooperman, an up-and-coming star, Nick, that's going to talk about some trust planning strategies that have been implemented for various clients. Nick, why don't you take it away?
Good afternoon, everyone. Today I'm going to be addressing a potential New York State resident trust planning strategy, primarily being located in New York City. This is a planning opportunity we see often. So I'm going to start by what is a New York State resident trust. New York State law defines two types of resident trust. That is a testamentary resident trust, a trust created under the will of a decedent who is domiciled in the state of New York at the time of death. And then there's the inter vivos or living irrevocable trust. Again, it's irrevocable, not revocable trust. And that is a trust funded with property by a resident of the state of New York at the time of funding. This would also apply, both of these definitions would also apply to New York City resident trusts within New York State, and the planning works for New York State and New York City as well. So New York State Tax Law Article 22 has section 605B3D. What this tells us is that there are three criteria which a trust has to meet in order for it to become a New York State resident trust exempt from income taxes. So yes, you can have a resident trust, either testamentary or living, and still be exempt from income taxes as long as you meet the three requirements. And they are that all trustees of the trust are domiciled in states other than New York. The entire corpus of the trust, which includes real property, tangible personal properties located outside New York State, and there's intangibles located at the state but not employed in a trade or business, are deemed located outside of the state as well. So if you have an LLC that only holds portfolio assets, those would not be deemed New York State assets since they are intangibles. And then all income and gains of the trust are derived from and connected with sources outside of New York State. So what does this mean? So if you have a LLC that has assets and it generates New York State income, you would not be exempt from New York State income taxes because it will look through the LLC and track the source of your income. Often with many of our clients, they have real estate assets within their trust, and those assets are creating rent rolls which are within the state or city limits. Now, this works for state planning. Now, if it'll also work for New York City trust planning, in that you could flip off the New York City resident status if the trustees also, and the trust meets the requirement for New York City source income, trustees, and real intangible assets. So there's two sides, there's the state and the city. Today, we're really just going to focus on the state. So two common scenarios we see when we're reviewing trust returns is that one of them is a resident trust, which only holds portfolio assets, and you have a New York State resident trustee. Often on older trusts, particularly trusts created by New York City residents, they choose someone close to them, a family friend, an advisor also located in the city, to safeguard those and administer the trust. The solution that is as simple as choosing someone outside of the state of New York to be the trustee of the trust. Either you could use someone else you trust as an advisor, a family member, or you could use professional service trustee, such as Delaware Trust Company, something along those means. The more interesting is when you have resident trusts that have both these portfolio assets and these real estate assets. But there's no New York State trustee. So you're saying, okay, I meet requirements 1 and 2. 2 and 3, and I don't have requirement 1, but no New York City trustee. So sometimes it would be as beneficial as bifurcating the trust, decanting into 2 separate trusts, the portfolio assets from the real estate assets. Again, this is something you would need to talk to both your accountant and your attorney on to make sure that the trust would permit such planning. But it's a way to take your portfolio assets out of your trust, which also contains your real estate assets, and have the portfolio assets be tax exempt from potential state and city taxes. And unfortunately, your real estate assets, because they're generating income on the New York source, will still be subject to New York. And that's back to you, Pat.
Okay, thanks, Nick. Nick, we talked about New York State. Do you know if other states have similar provisions?
New Jersey has a very similar provision. We used it yesterday. Again, that's no trustees domiciled in the state, it's the same 3, no real tangible personal assets within the state of New Jersey, as well as no income from New Jersey sources. New Jersey's definition is just about the same as New York's. Other than that, I'm not aware of other states that have the same, but don't forget, not all states declare residency based on the domicile of the grantor at the time of funding or death. So it really is a state by state basis.
Okay, back to me. So last creative tax planning strategy I just want to talk about is PTE planning. So hopefully everyone's heard about the pass-through entity tax. As I mentioned before, back in 2017, the IRS limited everyone's state and local deduction to this $10,000 cap. And this cap applies at everyone's individual level. So a lot of taxpayers in high tax-paying jurisdictions, New York and California, were not happy with this. They're not getting a benefit of their real estate taxes. High net worth individuals are paying a lot of state and local income taxes and getting no benefit. $10,000 limit, that's it. Getting no benefit. So a lot of these states wanted to come up with a workaround to this pass-through, and they came up with this workaround through this, what's called a pass-through entity tax. Now, the IRS came out with a notice back in 2020 blessing the concept of a pass-through entity tax. What that did was it gave businesses, operating businesses, an ability to deduct the taxes that were being generated at the entity level. Meaning, so if I had an accounting firm and my accounting firm made $1 million, and that $1 million, I would have owed $100,000 at the state level. If I didn't have a pass-through entity tax, I would be getting no deduction for that $1 million. The government allowed that now that $100,000 to be deducted at the entity level, which effectively now I'm only paying tax on $900,000, and that effectively at the highest personal income tax rates, $100,000 at 37% is saving me $37,000. So with the PTET, an election must be made every year to elect into the pass-through entity tax. Now, this topic we're talking about is creative tax planning strategies. So I'm going to tell you what we have done for a lot of high net worth individuals. This law was designed for operating businesses. Like I said, Citrin Cooperman makes a PTE election. So if we generated $1 million of income and the New York State tax on that was $100,000, net, you're only paying tax on $900,000 at a 37% tax savings. You're saving yourself $37,000. So what we did was, we deal with a lot of high net worth individuals that are generating a lot of interest, dividends, and capital gains. we formed it has to be through, this law must be imposed with a pass-through entity, so a partnership. So we formed LLCs for taxpayers. LLCs owned 50% by husband, 50% by wife. So instead of their personal 1099 being issued in their name, we had that 1099 retitled into the LLC name. We made a PTE election. So now that LLC is generating interest, dividends, and capital gains. So let's say we'll stick with the $1 million because it's easy for my math. So that LLC now is generating $1 million of interest, dividends, and capital gains. You're going to be paying tax on that $1 million. So if I had those 1099 in my name, I'm paying that $100,000 tax and getting no benefit. We made the PTE election at the entity level, paid that $100,000 of tax at the LLC level. So effectively now I am only paying tax on $900,000. I saved my taxpayer $37,000 by implementing this strategy. However, there's about 35 states that have PTET rules. California's rule is a little differently. California's rules primarily states that the PTE only relates to operating businesses. So I could not do this with this investment partnership that I filed. New York State gives me the ability to implement this PTE planning for investment partnership. Also, if you're a New York City resident, it also works for New York City now. The initial law did not allow that, but New York State came out with a revision of the law about 3 years later, and New York City residents also qualified. We've had clients save millions and millions of dollars with this planning, especially, we deal with a lot of clients that are in the, let's say, the private equity world, and there have been gains. They sold an asset at the private equity LLC level. Their companies, their entities are making PTE elections, and generally what's being generated on a private equity when they have an exit event is carried interest, which is construed as capital gains. They are saving millions of dollars on this planning idea. So the planning idea is, if you have an individual that has tremendous amount of, and they're a New York State resident that has a tremendous amount of interest, dividends, and capital gains, you should reach out to your advisor to see if the PTE planning is a viable tool to implement. As I said, we have saved clients millions of dollars with this strategy, and the IRS has blessed it with this notice back in 2020. Creative tax planning strategy. Just a few other nuances. You need to make an election by March 15th of every year. You're going to have to pay estimates at the entity level. So you're going to have to make tax payments at the entity level on a year-by-year basis, just like you do as an individual, as an estimated payment. You'd be doing this same concept under your LLC level for this PTE filing. Creative strategy that we've implemented and saved clients millions and millions of dollars. Any other questions? We wanted to keep this to an hour. Any other questions or comments? If you could put in the chat, we'll answer, because we have like another 2 minutes. But we are always trying to come up with ideas and strategies that help taxpayers. That's why we brainstorm on a continuous basis among the practice leaders at Citrin Cooperman to see what the marketplace is doing. We know for a fact this PTE strategy and this investment interest strategy that we talked about before are being implemented not just by Citrin Cooperman clients, by a tremendous amount of other people, because it's something in the marketplace that's getting steam. So I would advise you, if you have the right fact pattern, reach out to your advisors and say, will any of these strategies work for me? And talk through and understand the benefits and the detriments by implementing any of these types of strategies. Again, I want to thank Steve, Heather, and Nick for their participation today. And I hope everyone got something out of this. Like I said, we're always just trying to bring ideas and strategies out to our clients to help them achieve some tax efficiency and tax savings.